Okay, let's unpack this. Today we're diving into a stack of fresh reports from EIOPA, all hot off the press from just yesterday, July 14, 2025. And these aren't just minor tweaks, are they? They feel like pretty significant insights into how Solvency II is being refined.
Oh, absolutely. And crucially, how supervisory authorities are going to be operating.
Right.
So our mission today, really, is to give you, the insurance risk manager listening in, a bit of a shortcut, a way to get well-informed quickly on these final reports.
Yeah, cut through the noise.
Exactly. They bring clarity to some genuinely critical areas for your compliance role, how groups are identified, how cross-border activities are assessed, even the nitty-gritty of your solvency capital requirement calculation.
Is there, yeah.
We've tried to distill this down to the most important nuggets for you to help you stay not just compliant, but maybe, actually ahead of the curve.
Okay, good. Let's jump right into that first core topic then. It feels like a big one. Redefining what actually constitutes a group under Solvency II.
It is big, yeah.
We know the Directive 2009-138EC has been reviewed, and this new Directive, 2252, specifically amends Article 212. What's the key change risk managers need to get their heads around here, especially with these so-called horizontal groups?
That's a great question. What's really fascinating, I think, is the shift in focus. Supervisors are getting much more specific factors now for identifying dominant or significant influence.
Influence, right.
Or spotting where undertakings are essentially managed on a unified basis, even without obvious capital links. It's not just about shareholdings anymore.
So less about the org chart on paper.
Precisely. It's more about the underlying operational and strategic reality. These draft regulatory technical standards, the RTS, they explicitly state their mission. Promote supervisory convergence in identifying these relationships.
Which means more consistent supervision across the board, hopefully.
It's the goal, and it supports more effective group supervision overall. For your firm, this means you really need to look beyond that traditional organizational chart.
It sounds like supervisors are trying to trace those maybe invisible threads connecting entities, even if there isn't a direct parent-subsidiary line.
That's a good way to put it. Invisible threads.
Can you break down those four core factors? They're mentioned in Article 212, specified in the RTS. What's really new or significant there for our listeners?
Absolutely. Let's take them one by one. The first factor in RTS Article 1 is all about the ability to influence decisions.
Okay.
And this moves way beyond just looking at capital or voting rights. Supervisors will, of course, look at contracts, but critically, they'll also consider de facto influence.
De facto. So the reality on the ground.
Exactly. Think about the practical ability to influence who gets nominated or appointed to the board or management or supervisory bodies.
Right.
Can one entity influence significant transactions in another, or material changes to its financial position, solvency, even its basic business model? And here's something interesting, maybe a new area for many firms to think about. They're even looking at whether key personnel are related parties, or maybe former employees of the influencing entity.
Wow, okay. So it's not just legal structures. It's about the people, the human connections, the operational command lines.
Yes. It's almost like a forensic analysis, as you said, of who's really pulling the levers.
Okay, makes sense. What about the second factor?
Moving to RTS Article 2, we get strong reliance on another undertaking. Here, supervisors will examine transactions that significantly impact a firm's business model or financial position.
Significantly. That sounds broad.
It is broad. It covers financing, like subordinated liabilities, equity, cost-sharing deals, guarantees on significant obligations, even reinsurance arrangements.
Okay.
But the crucial part, I think, for risk managers listening is that it also includes the sharing of key functions. Things like outsourcing critical activities or sharing technical or operational functions, IT systems, employees.
Shared services, essentially.
Yes, or even sharing a brand, product strategies, claims handling processes, distribution channels, or essential technical information. Basically, if one entity's operations would effectively grind to a halt without the other, that's a big flag.
Right. That paints a picture of potentially deep operational entanglement, even without direct ownership. What's next?
Then we have RTS Article 3. This one focuses on the coordination of financial or investment decisions.
How would they spot that?
Well, evidence could include shared decision-making bodies. Think committees where staff from different undertakings work together on group-level policies.
Yeah.
They'll look for close links between personnel and key functions, perhaps rotation of key people across undertakings, a strong indicator. If one person is responsible for a key function across multiple entities.
Right, one person wearing multiple hats.
Exactly. Or shareholders reps making joint proposals, even just strikingly similar investment strategies or risk exposures across the supposedly separate undertakings.
Okay, and the final piece.
Yeah.
The fourth factor.
The fourth factor, detailed in RTS Article 4, is about coordinated and consistent strategies, operations, or processes. And this really goes beyond formal contracts.
How so?
Supervisors will look for the same individuals or undertakings exercising influence across the board. Shared shareholder reps, again, making joint proposals. Direct links between decision-making bodies, maybe the same people sitting on multiple boards or management committees.
Okay.
It also extends to similar business strategies, pricing, claims handling, risk, and capital management policies, including how dividends are decided, even shared internal control systems, outsourcing deals, or sharing the same physical head office.
So really looking at the whole operational picture. Now, you mentioned a critical nuance for compliance. It's not about ticking all these boxes individually.
That's vital, no.
It's more about building a case.
That's right. Supervisory authorities are not looking for every single supporting element to be present. They are building a body of evidence. They'll assess the significance and continuity of these factors and elements. So, for your internal assessments, what does this mean? It means they need to be far more comprehensive, more nuanced than before.
You have to anticipate the scrutiny.
Exactly. Anticipate scrutiny even if the formal legal links seem weak. The core insight here is supervisors are building a holistic picture. They're moving away from just formal links to the actual operational reality of influence.
Which fundamentally changes how your firm needs to document and assess its relationships.
It does.
Now, I can imagine some risk managers hearing proportionate approach and maybe breathing a sigh of relief, thinking it means less work. Is that accurate, or is there a catch?
Yes. That's a common reaction, but potentially misleading. While the preferred approach, policy option 2, does mean supervisors aren't required to dig into all elements in every single case.
Allowing them to be proportionate, case by case.
Correct. But, and this is the crucial part, it absolutely does not reduce your firm's need to be prepared for scrutiny across all potential indicators.
So the burden of proof or readiness is still on the firm.
Precisely. It aims to enhance efficient group supervision, ensuring proportionality, yes. But it places the onus squarely on the firm to be ready for that scrutiny. EIOPA stood firm on this, by the way.
Even with stakeholder feedback.
Even with stakeholder concerns that the criteria might be too broad or might inadvertently capture, say, third country groups. EIOPA basically said the existing frameworks already handle proportionality in third countries.
So for your firm, it means staying vigilant, being ready to articulate your group's true operational relationships. Not less work, just different work.
Exactly. More nuanced work, perhaps.
Okay, that's a really significant shift in focus. Let's transition now from that internal group structure to how your undertaking interacts beyond its borders. Our next segment, cross-border activities.
Right.
We're moving beyond that well-known EUR 15 million threshold. Most listeners probably know about the new Article 152AA of Solvency II, enhanced supervisory cooperation for significant cross-border activities. That 15 million euro GWP threshold is clear, it's quantitative. But what happens beyond that? What makes an activity of relevance to a host member state's market, even if it's technically below that premium threshold?
This raises a crucial question for you as risk managers, absolutely, because this new RTS clarifies those vital qualitative criteria.
Qualitative, okay.
The mission here is to support effective cross-border supervision, protect the market, protect policyholders in that host state, all without introducing new thresholds. The directive already has the quantitative one.
So it's about adding depth, not just volume.
Exactly. It's about understanding the impact.
So what are the main qualitative criteria? RTS Article 1 lays them out.
It does. First, we have concentrations of activities under RTS Article 1A. This looks at your undertaking share of activities in the host member state measured by gross written premium compared to your total GWP.
Okay, so your relative focus on that market.
Yes. And interestingly, supervisors will also look at your market share in the host member state's overall market, or specifically its life or non-life insurance and reinsurance market, measured by GWP or gross technical provisions.
And you mentioned that life-non-life breakdown was based on feedback.
That's right. That specific point regarding life and non-life markets was a direct result of stakeholder feedback during the consultation. Shows they are listening to some extent.
Good to know. What's the second main criterion then?
The second main criterion under RTS Article 1B is the material impact of activities.
Material impact. How do they measure that?
This assesses whether your activities have a significant impact on specific lines of business, specific insurance risks, or products that are considered important by the host supervisor.
Like compulsory insurance, perhaps.
Exactly. Things like compulsory motor insurance, which often has wider social or economic importance. And to gauge the significance of this impact, the RTS paragraphs 3, 4, and 5 of Article 1 outline how supervisors will look at market share for those specific lines, risks, or products.
Measured by?
Measured by premiums, number of policyholders, number of policies, sum insured, even the number of insured vehicles in some cases.
Okay, quite granular. And there's this factor you highlighted in the outline level of substitutability. That sounds really key.
It is. Very insightful, as you say.
If your undertaking faced issues, could policyholders easily find comparable alternatives elsewhere in that market? How critical is this for risk managers to grasp?
It's absolutely critical for assessing potential detriment from the supervisor's perspective. For your firm, if you operate in a niche market, maybe highly specialized products with low substitutability,
You should expect more attention.
you should anticipate closer supervisory scrutiny, yes. Even if your premium volume is below that 15 million threshold, they'll also look at direct indicators of potential detriment.
Such as?
Things like the number of affected policies, whether your firm has a higher than average volume of complaints in that market, commission rates, are they unusually high, and even your GWP growth in the previous financial year, rapid growth can sometimes be a flag.
So if I'm managing risk for a firm in, say, a niche compulsory insurance market, highly specialized products, this substitutability factor sounds like it could really flag us for supervisory attention, even with relatively low premium volume. Am I getting that right?
You're absolutely spot on. That's precisely the kind of scenario where these qualitative criteria bite.
So the implication for our risk reporting seems clear.
It is. You need to include insights into consumer complaints, policyholder numbers in specific segments, maybe even commission rates, to identify these potential relevance flags proactively.
Because the preferred policy option avoids rigid thresholds.
Exactly. It gives supervisors flexibility, which means your compliance strategy needs to anticipate these nuanced qualitative assessments. You can't just tick boxes based on premium volume anymore.
You need to understand your true market impact.
Precisely.
All right, shifting gears again. Let's move to something that might feel a bit more technical, but is equally vital for the balance sheet. Fine-tuning those solvency capital calculations.
Yes, the SCR.
We have two key updates here impacting the SCR directly.
That's right. And if we connect this back to the bigger picture for risk managers, these changes directly affect how your assets are risk-weighted.
And therefore, how your SCR is ultimately derived.
Exactly. First, let's touch on the revised implementing technical standards on regional governments and local authorities. That's EIOPA BOSS 25247.
RGLA. Okay.
The purpose here is simply to update the lists of regional governments and local authorities, or RGLAs, whose exposures get treated like exposures to the central government.
Which is significant
because that treatment results in a 0% risk factor for spread risk and market risk concentration in your SCR calculation.
Okay, so a direct financial impact on capital requirement.
A very direct impact. The specific changes. 4 new types of RGLAs from France. These collectivités à statut particulier, un établissement public de coopération intercommunale à fiscalité propre, and Latvia, the Vaspesa Pašaldība and Nova Pašaldība, they've been added to the list.
And on the other side.
On the flip side, following Brexit, the regional governments of the United Kingdom have been deleted from the list.
So the practical takeaway for your work.
Check your investment portfolios meticulously. These updates directly affect the risk weighting of exposures to these specific entities. It could change your SCR. It's a very concrete adjustment firms need to make.
Got it. What's the second update?
Next, we have the revised guidelines on undertaking-specific parameters, or USPs. That's EIOPA BOSS 25249.
USPs. Replacing standard formula parameters for the SCR.
Exactly. These are revisions to the existing guidelines from back in 2015, covering how supervisory authorities approve the use of USPs. The review aimed to align with the amended Solvency II framework, simplify things, shorten the guidelines.
Okay, simplification sounds good.
But, and this is crucial for you to remember, no new guidance is provided. And supervisory expectations are not reduced.
So it's more about clarity and streamlining, not lowering the bar. So despite this simplification, the core expectations for your firm's compliance haven't lessened at all. What are some key reminders for firms, even if some guidelines were shortened or deleted? What should risk managers keep top of mind?
Absolutely. First, regarding the role of expert judgment, Guideline 1 is crystal clear. Expert judgment is only an adjustment to existing data.
Okay.
It is not a substitute for missing data. And crucially, your firm must demonstrate that using it actually leads to higher compliance with data quality criteria under Article 219.
So you can't just say expert judgment to paper over data gaps. You need proof it helps.
Exactly. It isn't a shortcut for poor data.
Makes sense. What about ongoing compliance?
Then there's continuous compliance, covered in Guideline 6. Your firm must monitor its compliance with USP requirements constantly. It needs to be part of your own risk and solvency assessment, your ORSA.
And report changes.
And report any material changes in your ORSA supervisory report. Now, for remedy of noncompliance, Guideline 7 is quite stark. If you're found noncompliant, supervisors may grant a 3-month period to fix it.
May, not will.
May. They'll consider the degree, scope, time needed, but if it's not remedied within that period, or if they don't grant it, approval will be revoked.
Meaning back to the standard formula.
Back to the standard method. It's not a suggestion, it's a hard line.
Okay. What about deviations?
When it comes to significant deviation, Guideline 9 specifies what supervisors will scrutinize. They'll look at findings from their supervisory review process, the nature and size of the deviation, its impact, likelihood, and severity on policyholders, the sensitivity of your underlying assumptions, how long the deviation might last, its volatility, and importantly, this analysis will be done at the segment level.
Segment level. So you can't just look at the aggregate result. You need to understand where deviations are happening within specific lines of business.
Exactly. You need that granularity.
Okay. Anything else on USPs? Group level.
Yes, finally, for group-specific parameters, Guidelines 10 and 14 highlight that applications need specific information. And importantly, the group supervisor will consult with and consider decisions from other supervisory authorities in the college.
So other national regulators involved.
Yes, regarding individual undertakings, USP approvals, before making their final decision on the group-specific parameters. So coordination is key.
So the overall impact on your work here, despite the simplification,
is that the fundamental expectations for robust internal processes, solid data quality, transparent reporting, they remain very high. Your ORSA needs to fully address USP compliance and any material changes.
understand the consequences.
Understand the consequences of noncompliance, definitely. And be ready always to justify your use of expert judgment or explain any significant deviations.
Wow, okay. That was a really comprehensive deep dive today. We've covered a lot of ground from those intricate nuances of group identification through the expanded qualitative assessment of cross-border activities and right down to the fine print of SCR calculations with those RGLA and USP updates.
It's quite a package of updates, isn't it?
It really is.
So, boiling it all down, what does this all mean for you, the risk manager listening?
I think it clearly means the regulatory landscape keeps evolving. It's moving towards more nuanced, more evidence-based, and yes, proportionate supervision.
Right.
The challenge now, but also maybe the opportunity for your firm, is to move beyond just ticking compliance boxes.
Beyond mere compliance.
Exactly. It's about truly understanding the underlying principles behind these rules and being able to demonstrate the robustness of your undertaking's governance, your risk management, your capital calculations, especially when you're dealing with these increasingly qualitative assessments we've talked about. That really does raise a critical final thought, doesn't it? For every risk manager out there, how will your organization adapt? How will you change your internal monitoring, your reporting, to truly embrace this shift in supervisory focus? Moving from just reporting what the rules require to genuinely demonstrating how well you understand and manage the underlying reality of your risks and capital.
That's the key question to ponder, I think.
Definitely something to think about. Thanks for joining us for this deep dive.